Hi there, I'm Russ Horn, and today I'd like to show you a chart pattern called head and shoulders. Now, it's what it sounds like. The formation itself looks like a head in the center with a left shoulder and a right shoulder. Now, this is generally known as a reversal pattern. The market is going up, forms a head and shoulders pattern, and then comes back down again. Now, there's something called an inverted head and shoulders, which I'll talk to you about in a minute. But let's start with the basic head and shoulders pattern itself. Now, the reason why a head and shoulders pattern works to begin with is the market tends to move in a stair-step fashion. When the market is moving up or trending up, generally what it's doing is making progressively higher highs and progressively higher lows. So every time the market makes a high, it is followed by a higher high. And every time the market makes a low, it is followed by a higher low. So this means the market is trending upwards. Now, the same happens in a downtrend. When the market is trending downwards, it will follow that same stair-step type action. The highs will be getting progressively lower, and the lows will be also getting progressively lower. And the head and shoulders pattern itself is showing us that transition from progressively higher highs and higher lows to progressively lower highs and lower lows. So we're going to find this generally at the top of a market move. So we're going to see the market make a high, and we're taking a look at this little graphic that I've drawn at the bottom. Make a high, come down, make a higher high, come down, and then it's going to make a high that is not as high as its previous high. And this is the beginning, potentially, of a change in direction, which is why the head and shoulders pattern works. So what I've got here is a graphic that shows the pattern itself. We've got what's called a left shoulder, a head, and then a right shoulder. And of course, the head is higher than the shoulders. And in between, we have a couple of lows. So we've got a shoulder, a low, a head, a low, a shoulder, and then a market move. And in between those two shoulders and the head, we've got a couple of lows, and that is called the neckline. Now, ideally, the perfect head and shoulders formation forms a neckline that we can connect with an upward sloping trend line. Now, that's not always going to be the case, so we don't need to worry about that. Technically, this isn't quite correct, because if we are going to see a downtrend, going to see the formation of a new downtrend, we need the price to get lower than its previous low. So we've got the head and then the right shoulder, which is lower than the head. So the highs now are becoming lower. We need to see that the price gets lower than its neckline on the right side. So if I draw a new trend line, this becomes the area that we want to see the market break. And that's what we've got here. So if I draw, I'm just going to duplicate this. If I draw a trend line, or an area of support in this case, underneath the right neckline, which is what we see here, we've got the left neckline and the right neckline. Price breaks below it and then continues to move down. And this is indeed the beginning of a new trend, because from here, we've got a low that is lower than its previous low. Market does come back up, but this high that it makes is lower than its previous high. Now, technically, the way a head and shoulders pattern is traded is we're looking at the distance between the head and the trend line that we can draw between the neckline. So I'm connecting this low, connecting this other low to draw a neckline trend line. And this gap between the head and the trend line is what we're looking for as far as a target goes. So if I duplicate this distance, what we're looking for is when the market breaks below the trend line, that the market continues to move this distance. And we do get that eventually. The market does come down this way. Now, the way I prefer to trade this is not using the head, but instead using the right shoulder. So if I'm looking at the space between the right shoulder and the trend line, this is, for me, more of an ideal target. And I find more and more often that the market tends to move the distance between the right shoulder and the neckline. It tends to do this over and over. When we're aiming for the distance between the head and the neckline, it takes a little bit longer. Sometimes we get some pullbacks and it doesn't always get there. Now, this is called the head and shoulder formation, and this is in a bearish market. This is the turn from a bullish market to a bearish market. So we're looking to trade short. So we're looking for a close below the neckline and then a move downward. So let's take a look at a bullish head and shoulders formation. So what we've got in this area here is a bullish head and shoulders formation, or an inverted head and shoulders formation. It is an upside down. It's like a bat hanging from a ceiling. So we've got the left shoulder, the head, and then the right shoulder. And in an inverted head and shoulders, the head will be lower than the shoulders. So what we're seeing here is the left shoulder, market moves up, comes back down, makes a head, which is lower than the left shoulder. Market moves up, comes back down one last time to make the right shoulder. And in this case, the right shoulder will be higher than the head. So what we're looking for is just simply a change in the direction of the market. Now, what I've got is the ideal head and shoulders picture drawn, but we're not always going to see this ideal head and shoulders image in the market. So this is a great opportunity to take a look at how this could work. So we've got that stair-stepping action that we're looking at. Price is making progressively lower highs and lower lows. A high, lower high, lower high, lower high, low, lower low, lower low, lower low, and so on. Price is making a move down. From the head, price makes a higher high than its previous high. Comes back down to make a shoulder. This low is higher than its previous low. And then we just keep moving upwards. So from here, we can't draw that downward sloping trend line like we'd ideally like to see. So instead, we simply draw a trend line that goes across from that right neckline. Now, there's a couple of ways to trade this. If we are looking for the change in the market direction, which is what we're looking for, we could technically be taking a trade as soon as we get 1 pip higher than the right neckline. And again, we could be looking at the distance between, just going to draw this out to the side, the neckline, and the head, which would be here, and extrapolate that as the market moves on. Now, again, this is not the one that I prefer because the market isn't always going to do this. I feel a little bit better if I use the right shoulder and the neckline. And I target that. So either way, this is the bullish inverted head and shoulders formation. And you're going to see this all over the place. It's going to start jumping out at you. They're not always going to be super clean. The distance between the shoulders and the head aren't always going to be the same. Sometimes the shoulder will be snugged up a little bit more than the other shoulder. Sometimes they'll be a little bit dirtier looking, but as long as you're aware of the reason that the head and shoulders formation exists, that the price makes a stair-stepping action down and then makes a stair-stepping action up, and the head and shoulders shows us essentially the change in that market direction. We are going from a stair-stepping action in one direction to a stair-stepping action in the opposite direction.